Hi, guys, welcome back to yet another video. As today I'm going to take you to step by step what is Forex trading, investing in Forex and candlestick pattern tricks. What is Forex trading? Forex, or foreign exchange, can be explained as a network of buyers and sellers who transfer currency between each other at an agreed price. It is the means by which individuals, companies, and central banks convert one currency into another. If you have ever traveled abroad, then it is likely you have made a Forex transaction. While a lot of foreign exchange is done for practical purposes, the vast majority of currency conversion is undertaken with the aim of earning a profit. The amount of currency converted every day can make price movements of some currencies extremely volatile. It is this volatility that can make Forex so attractive to traders, bringing about a greater chance of high profits while also increasing the risk. How do currency markets work? Unlike shares or commodities, Forex trading does not take place on exchanges but directly between two parties in an over-the-counter (OTC) market. The Forex market is run by a global network of banks spread across four major Forex trading centers in different time zones: London, New York, Sydney, and Tokyo. Because there is no central location, you can trade Forex 24 hours a day. There are three different types of Forex market: spot Forex market, the physical exchange of a currency pair, which takes place at the exact point the trade is settled, on the spot, or within a short period of time. Forward Forex market, a contract is agreed to buy or sell a set amount of a currency at a specified price to be settled at a set date in the future or within a range of future dates. Future Forex market, a contract is agreed to buy or sell a set amount of a given currency at a set price and date in the future. Unlike forwards, a futures contract is legally binding. Most traders speculating on Forex prices will not plan to take delivery of the currency itself. Instead, they make exchange rate predictions to take advantage of price movements in the market. What is a base and quote currency? A base currency is the first currency listed in a Forex pair, while the second currency is called the quote currency. Forex trading always involves selling one currency in order to buy another, which is why it is quoted in pairs. The price of a Forex pair is how much one unit of the base currency is worth in the quote currency. Each currency in the pair is listed as a three-letter code, which tends to be formed of two letters that stand for the region and one standing for the currency itself. For example, British pounds United States dollar is a currency pair that involves buying the Great British Pound and selling the US dollar. So in the example below, British pounds is the base currency and United States dollars is the quote currency. If British pounds United States dollar is trading at 1.35361, then 1 pound is worth $1.35361. If the pound rises against a dollar, then a single pound will be worth more dollars and the pair's price will increase. If it drops, the pair's price will decrease. So if you think that the base currency in a pair is likely to strengthen against the quote currency, you can buy the pair, going long. If you think it will weaken, you can sell the pair, going short. What moves the Forex market? The Forex market is made up of currencies from all over the world, which can make exchange rate predictions difficult as there are many factors that could contribute to price movements. However, like most financial markets, Forex is primarily driven by the forces of supply and demand, and it is important to gain an understanding of the influences that drives price fluctuations here. Central bank supply is controlled by central banks, which can announce measures that will have a significant effect on their currency's price. Quantitative easing, for instance, involves injecting more money into an economy and can cause its currency's price to drop. How does Forex trading work? There are a variety of different ways that you can trade Forex, but they all work the same way, by simultaneously buying one currency while selling another. Traditionally, a lot of Forex transactions have been made via a Forex broker, but with the rise of online trading, you can take advantage of Forex price movements using derivatives like CFD trading. CFDs are leverage products, which enable you to open a position for just a fraction of the full value of the trade. Unlike non-leverage products, you don't take ownership of the asset, but take a position on whether you think the market will rise or fall in value. Although leverage products can magnify your profits, they can also magnify losses if the market moves against you. What is the spread in Forex trading? The spread is the difference between the buy and sell prices quoted for a Forex pair. Like many financial markets, when you open a Forex position, you'll be presented with two prices. What is a lot in Forex? Currencies are traded in lots, batches of currency used to standardize Forex trades. As Forex tends to move in small amounts, lots tend to be very large. A standard lot is 100,000 units of the base currency. So, because individual traders won't necessarily have 100,000 pounds, or whichever currency they're trading, to place on every trade, almost all Forex trading is leveraged. What is leverage in Forex? Leverage is the means of gaining exposure to large amounts of currency without having to pay the full value of your trade upfront. Instead, you put down a small deposit, known as a margin. When you close a leverage position, your profit or loss is based on the full size of the trade. What is margin in Forex? Margin is a key part of leverage trading. It is the term used to describe the initial deposit you put up to open and maintain a leverage position. When you are trading Forex with margin, remember that your margin requirement will change depending on your broker and how large your trade size is. Margin is usually expressed as a percentage of the full position. So, a trade on euros British pound, for instance, might only require 1% of the total value of the position to be paid in order for it to be opened. So instead of depositing AUD $100,000, you'd only need to deposit AUD $1,000. What is a pip in Forex? Pips are the units used to measure movement in a Forex pair. A Forex pip is usually equivalent to a one-digit movement in the fourth decimal place of a currency pair. So, if British pounds United States dollar moves from $1.35361 to $1.35371, then it has moved a single pip. The decimal places are shown after the pip are called fractional pips, or sometimes pipettes. Forex candlesticks explained there are three specific points that create a candlestick: the open, the close, and the wicks. The candle will turn green-blue, the color depends on the chart settings, if the close price is above the open. The candle will turn red if the close price is below the open. If you have the chart on a daily setting, each candle represents one day, with the open price being the first price traded for the day and the close price being the last price traded for the day. Open price: the open price depicts the first traded price during the formation of a new candle. High price: the top of the upper wick. If there is no upper wick, then the high price is the open price of a bearish candle or the closing price of a bullish candle. Low price: the bottom of the lower wick. If there is no lower wick, then the low price is the open price of a bullish candle or the closing price of a bearish candle. A close price: the close price is the last price traded during the formation of the candle. The image below shows a blue candle with a close price above the open and a red candle with the close below the open. Why Forex traders tend to use candlestick charts rather than traditional charts? Candlestick charts are the most popular charts among Forex traders because they are more visual. Candlestick charts highlight the open and the close of different time periods more distinctly than other charts, like the bar chart or line chart. Candlestick charts have certain advantages. Forex price movements are perceived more easily on candlestick charts compared to others. It is easier to recognize price patterns and price action on candlestick charts. Candlestick charts offer more information in terms of price, open, close, high and low than line charts. However, there are some disadvantages of candlestick charts. Candles that close green or red may mislead amateur Forex traders into thinking that the market will keep moving in the direction of the previous closing candle. Candlestick charts may clutter a page because they are not as simple as line charts or bar charts. How to trade Forex using candlestick charts. Candlestick formations and price patterns are used by traders as entry and exit points in the market. Forex candlesticks individually form candle formations like the hanging man, hammer, shooting star, and more. Forex candlestick charts also form various price patterns like triangles, wedges, and head and shoulders patterns. While these patterns and candle formations are prevalent throughout Forex charts, they also work with other markets like equities, stocks, and cryptocurrencies. Trading Forex using candle formations. The hanging man. The hanging man candle is a candlestick formation that reveals a sharp increase in selling pressure at the height of an uptrend. It is characterized by a long lower wick, a short upper wick, a small body and a close below the open. It is a bearish signal that the market is going to continue in a downward trend. Learning to recognize the hanging man candle and other candle formations is a good way to learn some of the entry and exit signals that are prominent when using candlestick charts.